All right, today we are going to rip apart one of the most misunderstood and honestly one of the most punishing parts of the US tax code, how your Social Security benefits get taxed. This is a hidden world of phantom tax rates and financial tripwires, and it's famously known as the Tax Torpedo. Let's dive right in.
So here's the game plan. We're going to start with the foundation, the law itself, Internal Revenue Code Section 86. Then we'll build the formula piece by piece, talking about provisional income and the thresholds that trigger the tax. After that, we get to the main event, the tax torpedo, and you'll see how it creates these absolutely shocking marginal tax rates. And finally, we'll bring it all back to the real world, looking at the Form 1040 and discussing why this matters so much.
Okay, let's start at the very beginning, at the source. You got to start with the letter of the law. Everything we're about to explore, every single calculation comes from one place in the tax code, IRC Section 8. This is the absolute rulebook. So this really gets to the heart of it for millions and millions of retirees, right? Is your benefit tax-free? Is 50% of it taxed? 85%? Well, the answer, as we're about to see, is it depends. And the way you figure it out is anything but simple. Now, Section 86 wasn't always around. It was actually added to the code back in 1983, and this was a huge deal because it totally changed the game for Social Security. It took benefits from being seen as this tax-exempt government payment to being a partially taxable source of income. And if you look at the actual language from the statute, this is where it gets really interesting. It doesn't just say some of your benefits are taxed. No, it sets up this complex formula. The taxable amount is the lesser of two different calculations, and that little phrase, the lesser of, is the key. It's what creates the whole phase-in effect that we're about to break down. Okay, so let's move to the engine of this whole process. We need to figure out this key number called provisional income. This one figure determines whether your benefits get taxed at all.
Now, here's a funny thing. The term provisional income, you won't actually find it written anywhere in the tax code. It's a term that industry came up with to make sense of the formula in Section 86. And that formula is your modified adjusted gross income, or MAGI, plus 1/2 of your Social Security benefits.
But hold on, and this is a huge detail for anyone doing the math. MAGI isn't just MAGI. The definition of modified adjusted gross income for this specific purpose, for taxing Social Security, is unique. It starts with your regular adjusted gross income, your AGI, and then forces you to add back certain types of income you thought were excluded. So what are we adding back? Well, the most common one, and a huge trap for retirees, is tax-exempt interest from things like municipal bonds. So that interest might be tax-free for regular income tax, but for this calculation, it gets added right back in. Same goes for things like the student loan interest deduction. The code is basically trying to get a much broader picture of your actual cash flow. Okay, so once you've got that provisional income number, you're not done. Now you have to stack it up against a set of two-tiered thresholds. These are the magic numbers that determine if you pay tax on 0%, 50%, or up to 85% of your benefits. And here they are. For a single person, that first line in the sand is $25,000. For a married couple filing jointly, it's $32,000. If your provisional income crosses that line, boom, up to half your benefits could be taxable. Then there's a second, higher threshold, $34,000 for singles, $44,000 for couples. Cross that, and now you're in the 85% zone. But just look at that last line for married filing separately. The threshold is 0. And that is not a mistake. It's a deliberately punitive rule to keep couples from trying to game the system. Okay, now we get to the main event. This is why we're all here, right? We've laid the groundwork with provisional income and the thresholds. Now let's see how they combine to create this crazy phenomenon called the tax torpedo. The tax torpedo is all about this massive hidden spike in your effective marginal tax rate. See, it happens because every extra dollar you earn does two things at once. That dollar gets taxed itself, and it drags a chunk of your supposedly untaxed Social Security benefits over the line into taxable income. The formula you see here captures that perfectly. Your effective rate is your normal tax bracket multiplied by this extra inclusion factor. Let's see how that works. Let's break this down. When you're in that first phase-in zone, every extra dollar of income you earn makes 50 cents of your Social Security benefits taxable. So that $1 of income just created $1.50 of taxable income. It's wild. Your effective rate becomes 1.5 times your normal tax bracket.
Then, in that second zone, it gets even crazier. $1 of new income makes 85 cents of your benefits taxable. Now your taxable income just went up by $1.85, so your effective rate is 1.85 times your bracket. So what does that actually feel like? Let's put some numbers to it. Say you're a retiree who's normally in the 12% tax bracket. The moment you enter that first phase-in zone, your tax rate on the next dollar you earn isn't 12% anymore. It's 18%. And it doesn't stop there. As your income keeps creeping up and pushes you into that second 85% inclusion zone, that same person in the 12% bracket is now facing an effective marginal rate of 22.2%. That is nearly double their supposed tax bracket. And here it is, the classic brutal peak of the torpedo. Imagine a retiree in the 22% statutory bracket. Once they're in that second phase-in zone, their effective marginal tax rate skyrockets to a punishing 40.7%. Think about that. That's a higher marginal rate than many millionaires pay. But believe it or not, it can get even worse. Just when you think it's over, the distortion gets supercharged in what some people call the capital gains bump zone. This is a nasty little spot where the extra taxable income created by the torpedo actually pushes your long-term capital gains from the 0% tax bracket all the way up into the 15% bracket. This creates what planners call a triple whammy. A single extra dollar from, say, an IRA distribution triggers a 3-car pileup on your tax return. First, you pay ordinary tax on the dollar itself. Second, you pay tax on the Social Security benefits it just made taxable. And third, you pay a new 15% tax on capital gains that were supposed to be tax-free. It's a cascade effect. And the result of all that? The effective marginal tax rate for a retiree with just a moderate mix of income can hit a staggering 49.95%. For that one extra dollar of income, the government takes nearly 50 cents back. This isn't an opinion. It's a mathematical reality baked right into the code. Okay, so that's the scary math. But how does all of this complex theory actually show up on a tax return? Let's connect the dots and look at the Form 1040 reporting mechanics. You know, when you get down to it, all this crazy math boils down to 2 simple lines on the Form 1040. Line 6A. That's easy. That's just the total benefit amount you get on your Form SSA 1099. But line 6B. That's where all of the complexity, all the math, all the pain lands. That's the final taxable amount, and it comes from a detailed IRS worksheet that does everything we've just talked about. Now, the official IRS worksheet for this is frankly a beast. It's 19 lines long and can make your head spin. But really, you can boil all that logic down into this simple 5-step process. It calculates your special MAGI, adds half your benefits to get your provisional income, compares that number to those 2 thresholds, applies those tricky lesser of rules from Section 86, and finally it spits out the number that goes on line 6B. All right, let's pull back and put a bow on this. What are the big takeaways here, and why is this deep dive so absolutely critical for any kind of professional tax or financial planning? And here is the absolute kicker, the single most important thing to understand about this entire system. Those thresholds we talked about, the $25,000 for singles, the $32,000 for couples, they were set back in 1983, and they have never been adjusted for inflation. What started as a tax targeting high-income retirees has, over decades of wage growth and inflation, become a trap for the middle class. So the question this leaves all of us with is, what does this stealth tax mean for the future of retirement security? And how do you plan around a torpedo that's aiming for a bigger and bigger part of the population every single year?